Well, we're going to begin our discussion of financing in the corporate sense, talking about a world that is what's referred to as a perfect market. And we'll talk about exactly what that means as we get through here. But let's think about a company. And this company has essentially a project that they want to do. They can spend $800 today, and in the future, they're either going to get $1,400 or $900, depending on which scenario happens, a good economy, a bad economy, and there are equally likely chances of this occurring. So if we were to do a little math here, and using our capital budgeting techniques worksheet, we can calculate the net present value for this project. So we're going to spend, as you see here, we spend $800 in the beginning, and the cash flow in 1 year from now is $1,150. Now that's half of $1,400 plus half of the $900 is our $1,150. We have, as far as our discount rate, they tell us that the risk premium is 10% and that the risk-free rate is 5%. So the total discount rate is the combination of those, obviously, which is 15%. So if this company does this project, they're going to increase the value of the company by $200. So the question is, what happens if they finance this with equity only? What is the present value of the equity's cash flows? So if you find the present value, $1,150 is the future cash flow, find the present value, that's $1,000. So if I can raise $1,000 by selling some stock, and then I pay the $800, again, here's where the net present value of $200 comes in. I'm doing something that's worth $1,000. I only spend $800, so the other $200 obviously goes to the value of the company. Now, since there's no debt, right, these cash flows, this is what's going to be referred to then as unlevered equity, right? Levered means it has debt. Unlevered means it doesn't. So in this case, the initial value is $1,000. That's what the company is, that's what this project is worth. $1,400 is a strong economy, $900 is the weak economy. And if you calculate the returns on that, in a strong economy we'll make roughly 40%. 1,400 divided by 1,000, that's 140. 1.40 minus 1 is 40%. Weak economy, we lose 10%. So the shareholders' returns are either 40% or 10%. And of course, that averages out to the 15%. So because this cost of capital was 15%, and that's what the required return was, then in the end, we're saying that this is an appropriate return for this kind of project, given this level of risk. Now, what if we decide to borrow $500 instead of using all stock? If we borrow $500 and the interest rate's 5%, it's risk-free debt. At the end of 1 year, we're going to have to pay $525 back to the bondholders. Now, the equity we're talking about now, the ownership position, is now levered equity since there is outstanding debt. So if we give this $525 debt obligation, how does that affect the cash flows? So now we know that we're going to get $1,400 or $900 in the future. The firm has $1,000. We know that's what it's worth. But now we have this debt cash flow. So the cash flow that ultimately goes to equity is the difference. 1,400 subtract 525. Then the equity holders in a strong economy get 875, and in a weak economy get 375. So the question we now have is, what is the value of the stock in this levered equity position? In the previous position where we had no debt, all of the value belonged to the shareholders. So that was $1,000. What we ultimately have now is a position where we talk about the law of one price, right? Modigliani and Miller say that in a perfect capital market, the total value of the company will not depend on its capital structure. They say basically that the cash flows are still the same. Nothing has changed. The only thing that really has changed is who gets the money, whether the value goes to creditors or whether the value goes to owners. So since the value of the debt's 500, the value of the stock also has to be 500 because it has to equal the total value of the company, which is that $1,000. So again, because the cash flows are smaller than for the levered or smaller than the unlevered, obviously levered equity is going to have a lower price. However, you're really not worse off, right? You're still going to raise a total of $1,000. Okay, so at first glance, this seems a little strange, right? But if you think about it, less money is invested to get a total different return on the equity investment. So leverage increases the equity of the risk of the equity of the company. Even if we have risk-free debt, there still is an increase. Leverage is the magnification of returns by using these fixed costs. So if that is true, then that 15% discount earlier from the unlevered company is now not appropriate for the levered equity, right? Because the risk of those two ownerships has changed. So if the risk has changed, then obviously the discount rate or the cost of financing probably should have changed. In fact, probably it would have changed. So now we look at these new returns, right? So here's the debt, right? 525, again, they get 5% no matter what happens. But what about the levered equity? Again, the value now is 500. So how much do they earn in a strong economy? If you take 875 and divide it by 500, that's 1.75. So in a strong economy, they'll make 75%, but in a weak economy, they'll lose 25%. So the expected return for the levered equity total, when you do the math here, is 25%. So they're going to earn a higher rate of return. They're going to expect to get a higher rate of return. So the company is obviously going to have to pay that. So again, what we see here is that even though the debt is risk-free, there still is an increase in risk to the levered equity of the company, so the cost of financing is ultimately going to change. And again, we can see this in a number of different ways. We can look at risk premiums, right? The risk premium of the unlevered equity, 15% minus the risk-free is 10%. Levered, it's 20%. And again, the risk premium of the debt is obviously 0 because it's risk-free. And again, in this case, we see the what? The levered equity has a higher risk premium than unlevered equity. So in the case of perfect capital markets, if the firm is 100% equity financed, they're going to require 15%. But as soon as we introduce debt, all bets are off on that 15% now, because the risk level is ultimately going to increase. These equity investors are going to see this, and they're going to require a higher rate of return based on this risk level. So in summary, what we found in this first part here is that leverage increases the risk of equity even if there's no risk of default. So while debt's cheaper, it does increase the cost of capital for equity. So what happens to this cost of capital as we alter the financing mix? And that's really what these next several videos are all about, is what happens to value when we change debt. And what happens to value is dependent on what happens to the cost of financing the company. So that's the end of video 1.